Hello, everyone. Thank you for being with us here today. My name is Dadi Kristjansson, and I'm from Iceland. I'm honored to be joined by some of the brightest minds in the industry, and we're going to discuss macro trends in digital assets here today. So let's start with Martha. If you want to introduce yourself, and then we go back to the macro discussions.
Good afternoon, everyone. Thank you for being here, and thank you for the invitation. As I was already introduced, Martha Reyes from Fidelity Digital Assets. I'm on the research team. We're a team of 10 people now. 3 years ago, we were only 3, so we continue to expand. I'm a former emerging markets fund manager specializing in equities, and I'm delighted to be here.
Hi, everybody. Thank you for inviting me, and it's a pleasure to be here. My name is Paul Brodsky. I'm a partner at Pantera Capital. We have about $5 billion under management through 4 or 5 strategies. I previously ran a macro fund, so I'm delighted to be here and excited to talk about macro.
Hello, everybody. It's good to be back. My name is Maurice Mureau. I'm the CEO of the Hodl Group, which is a digital asset fund manager in Europe. We have a few strategies: directional, VC, and delta neutral, market neutral. And yeah, great to talk about macro trends in digital assets.
Hi, everyone. I'm Dina. I'm at Agnostic Fund. I'm a partner there focused on portfolio management. So we're a Thailand-based liquid token fund. Started my crypto career when I was at Bridgewater, and so looking forward to having this conversation about macro.
Hello, everybody. Michael Ashby, CEO of Algoquant. We're a quantitative investment firm that allocates to external managers as well as internal. We're also in the process of developing a fixed income market for digital assets, which we're excited about. And I have a background in working in large traditional hedge funds, macro and credit. I'm excited for the conversation.
So I run a crypto hedge fund out of Iceland. It's a liquid long biased fund. So we are very macro-oriented, and that's why we're here. The macroeconomic environment today is very exciting. We've seen interest rates coming down this year, and finally the Fed cut rates by 50 basis points last week. The dot plot shows that we could see 50 more basis points coming, and very interesting stuff. Markets have been taking it well, and what I would like to hear from the panelists are, like, what are your current macro outlook, and how do you see that affect the digital asset market until year end? Michael, let's start with you.
Sure, it's a very interesting time globally. I sort of see 3 main thematics. There's a change of the guard politically, potentially in the US, which we're all focused on in the next month or so. We have global tensions between a couple of different hotspots currently. And then finally, to your point, we have some monetary changes happening. And so I think the question is this a mini cycle change or a longer term cycle change? And what becomes a new normal? And what does that mean for digital assets? So I have absolutely no idea, but I'm interested to hear what this group has to say.
Dina, you're next.
So we've had the most bullish version of the rate cut that we could have really anticipated. So 50 basis points, there was a lot of uncertainty before going into it, possibly around recessionary risks, what the implications of a 50 bips cut could look like. But the way it's come out has been very positive. And so the overall outlook remains that the economy is strong. And so that obviously puts at ease the recessionary risks we've seen over the past few years. And so that's finally behind us. That's been a major bottleneck and blocker for allocators that have potentially been interested in going into this space. So we think through to the next few months and early into next year, it lays the foundation for the broader global macro environment in a pretty positive way. So the other obvious thing that's still holding people back is the uncertainty around the elections. And that is obviously going to be more optimistic if Trump wins, possibly less optimistic if Kamala wins. But I think regardless, just the certainty of what that outcome looks like will be pretty beneficial for allocators across the board. So once they have a decision around which way it's going to go, they can make their portfolio management decisions and allocate into the asset class. For crypto, I think that certainty will definitely lay the foundation for finally going into the asset class more heavily. So whether it's Kamala, it's probably not as bad as everyone fears. If it's Trump, it's probably not going to go as quickly or as optimistically as everyone hopes. And so at the end of the day, the probable trajectory for crypto, the pace might change as a result of who wins the election. But regardless, we think that the certainty and conclusion to these big pivotal questions that have been on our minds for a couple of years now are finally going to get resolved this quarter. And so overall, that implications are a pretty positive outlook for the next quarter and likely early into next year.
Maurice.
Yes. I think that the last few months, it's all been, is it going to be a soft landing or a hard landing? The economy globally is going a bit slower, and I think we're quite happy at Hodl that the Fed decided to lower 50 basis points instead of 25. They're always accused of being a bit slow, reacting to what's happening, and I think they really stepped up this time. And they know when they started it, it's going to be the first of a few more. So already we have the discussions, is it going to be 1 or 2 more quarters this year? But I think it's a good sign that we can actually be able to follow the Fed into the soft landing scenario that they obviously prefer. And if I look at the economic numbers, it still looks strong in the US. It looks a bit less in Europe. And I can also see some troubling in China. But yeah, hopefully the monetary policy makers will do that thing. And this could be actually quite good for the digital asset space if we manage to keep the economy running by lowering interest rates for quite a while. So we're pretty confident for next year, and let's hope that we will make it happen.
Paul, do you agree with Maurice, or do you have some recession fears for next year?
I do agree with Maurice. I think it's a great time to very constructive on risk assets. I think the Fed was bound to drop rates at some point, having less to do with the domestic economy in the U.S., and more to do with finance, with funding debt. We're at 35 trillion, going way out in U.S. Public debt. The housing sector has been weak in spots. And so I think the Fed was bound to begin dropping rates, and I think they'll continue to do it until we see GDP stabilize, which it's very at risk of now. So I think there's going to be, I guess, a soft landing. I don't think it'll be in those terms, but it's a good time to have risk assets. I'd go a step further and say we've seen anticipation of this in high growth equity, but not really in crypto, in liquid crypto. A lot of algorithmic traders, and I know we have one on the panel, have included Bitcoin in their risk appetite, leveraging up 12 to 20 times. And as long as Bitcoin can be traded algorithmically in the same manner as NVIDIA, it's going to move up and down and be correlated. But over time, it's doubled every 2 years for the last 10. And when rates are coming down, I think it's a pretty good time to allocate.
Martha, how are your views on the macro situation? And maybe do you feel inflation risk is possibly on the rise?
Gosh, it seems like this is a consensus trade, because I'm going to have to agree that I feel like I sound like a broken record. We've been saying a soft landing since the beginning of the year, really, and we continue to see that over the next few months. We're at the start of an easing cycle, which is a positive backdrop. And we've got earnings expansion as well. The S&P 500, the average stock is trading at 18 times PE, which is not egregious by any means. So what we've been seeing is a rotation and a broadening out of performance away from the Mag 7 into the broader stock market and the Russell 2000 as well. the beginning of that rotation, it was a bit violent, and we did see some volatility in the market, but that seems to have come down. That's probably one concern we do have with regard to the market, is how that rotation will occur. And also another thing that we think is more to do with 2025 and not now, too early to answer, is how far will that easing cycle go? At the moment, the market's already pricing in a Fed fund rate below 3% at 2.9, which to us feels a bit rich. It's more on the accommodative side. We think maybe the place to be should be more neutral, but it's still a bit early to say. It depends on the labor cycle and how far we swing in the pendulum the other way, right? So that is all positive, but I think it's important to keep in mind, like, what are the drivers for Bitcoin in particular, which is the largest cap digital asset? And we see the strongest correlation with M2. So that's with liquidity. Liquidity is ticking back up, whether it's China, although the Chinese measures are somewhat limited at this moment, but whether it's central banks easing around the world, and financial conditions are positive, and that is a driver in the longer term. In the short term, digital assets have other drivers if you're looking at 12-month periods or 6-month periods, whether it's elections, regulation, oversupply, Mt. Gox, there's all sorts of reasons. But we do think that Bitcoin is an ideal monetary good. It has a hard supply cap, and it should function as a store of value for people around the world.
In other words, Bitcoin is now a macro asset, and the institutions are starting to see it. So on that note, it would be interesting to hear again from you, Martha. Have you seen something in the past, like a new asset class coming up, and can you describe how the institutional adoption happens in a new asset class?
Certainly, yeah. I mean, I think it's helpful to go back and look at other asset classes and how they've emerged, their journey to become mainstream. Of course, you can draw the analogy too far because every asset class is unique. They have their own unique characteristics. In the case of commodities, for example, having been an emerging markets investor for many years, we kind of went back and looked at how that evolved over time. One big difference is that commodities were already recognized. People have been trading commodities for millennia, basically. So that part of it is different, but we would say that there was a lot of at the beginning, it was a niche asset class. And it wasn't really until the 50s that we had diversification introduced as a concept for portfolio allocators that people began to think along those lines. But it took decades. It wasn't until the 70s that diversification became more widely accepted. In the case of commodities, it was really difficult to access commodities unless you were like a niche player specializing in commodities and you were looking to hedge your exposure. And then you had things like the Goldman Sachs Commodity Index in the 90s, which allowed people to gain exposure to that space through the futures market. And then later on, we had the launch of the commodities ETPs as well, which kind of opened the floodgates. And there was a seminal piece in 2004 by a US Ivy League university that pointed out that actually commodities had a negative correlation to other asset classes that really allowed asset allocators to start allocating to that space, and also right on the bandwagon that was the Chinese economy at that point in time.
Very interesting. Paul, you've been in finance for a long time. Do you have any stories to tell also on some similarities when you're looking into the institutional adoption of things?
How dare you? So I was around when securitization started to get hot, and it changed the framework of investing for institutional investors with permanent capital that had liabilities to match. And so it went from almost zero allocations to securitized products to something in orders of magnitude greater in the trillions. This reminds me of that. Specifically tokenization, it seems to be a better form of securitization. Far better distributed, better, faster, quicker, fairer, better governance, the whole show. But my sense is that this thing of ours, this crypto market, this blockchain space, is going to start catching on to permanent capital once matters in regulatory framework become more clear. We think that's 12, 18 months away in the U.S. The U.S. has in the past been influential in global regulatory matters. The election, we're actually thinking it will not promote, but be benign, which in the U.S. is really all we needed in the securitization business to go crazy. I think this analogy from securitization to tokenization and investing in crypto, making it okay, I think we're going to begin to see permanent capital and fiduciaries begin to allocate, on the lines of 50 basis points in 12 to 24 months.
Very interesting. So what do we need to do to accelerate this process? Like, how can we show the institutions that Bitcoin is truly a great diversifier? Maurice?
Yeah, that's a good question. I think we have to take one step back and look at the asset class itself. It's actually an entirely new technological-based asset class with no borders that actually reshapes the whole financial system as we know it, because we're talking about the decentralized finance on one side and traditional finance on the other side. So we just kind of compare ourselves to what happens in the past, but we're also integrating it into the traditional finance. To get to the question, how did we get the institutions in? Yeah, there's a few things that needs to be kind of cleared. It needs to grow more, because now all the digital assets together combined are probably half the market capital of Apple. So it's still very tiny, and if you have large pension funds, for example, and you want them to have an exposure to an asset class that's relatively small, it will take a bit of time. But on the other hand, with the ETFs, for example, beginning of this year, you can see the institutionalization of the asset class already started. And I think with the tokenization coming, I think all assets in the world globally will be tokenized at some point. Because it's obvious that if you can trade one asset 24/7, 7 days a week, why shouldn't you be able to trade them all? So I think it's small steps. We're obviously going to touch regulation later, which is also important for institutions. It will take a bit of time, but I think we can definitely see the first steps in the right direction with all the things that happened this year.
Michael, you have something to add?
Yeah, so we see the world in two different shapes. So on the one hand, there's the deregulated part, which is the innovation. I think it's really important that we have a sand pit for people to create new products. And then we see a regulated side. So at Algoquant, we've partnered with a firm called Pantera, which is based in Austria, and they have regulated licenses to provide a regulated market for tokenization. And so in order to get permanent capital and to bring the large European institutions into this marketplace, we need to de-risk it. And you do de-risk it by creating a regulated market. And so I think you're going to have the R&D world, which is the mem coins and all these innovative products and all the super intelligent people working on this. And then it will slowly migrate into what I call boring crypto. And that will sort of be the regulated mindset. It will be slow, but we're starting to see that accelerate.
That makes sense. I feel we have a great story to tell. It's just a matter of getting the institutions to listen. So if I take the example from where I'm from Iceland, and we have some investors within our fund, and most of them are high net worth individuals and family offices. Those are the most open to new ideas, it seems. but we're gradually working on getting the institutions on board. And finally, with the entrance of the ETFs, with the Fidelities and the BlackRocks of the world being very open about this asset class, it changes everything. So all of a sudden, these institutions are more willing to listen. And then it's our job to meet them and educate them because, as I said, we have a great story to tell. Bitcoin has proven itself to be a great diversifier in portfolios. And obviously, other crypto assets will do that as well. So this is kind of the way forward. We just need to keep at it. And yeah, that's kind of how I view it. Dina, you have
Yeah.
something to add?
Yeah, I was just going to add, the more practical thing is putting crypto in your portfolio for institutional allocators is still considered career risk. So as we see first movers, the first couple endowments or pensions starting to make the moves, the others are going to have to follow. But those leaders are making a significant career risk by adding crypto in their portfolio. And so while we still have some uncertainty around regulation, the elections, et cetera, people are kind of sitting on their hands. But as you see a couple of the bigger players move forward and start deploying into the asset class, it's going to become a career risk not to hold crypto. So when that floodgate really starts opening, it's going to open really fast, and everyone's going to want to invest in the asset class, and the asset class will boom as a result. And whether it's holding Bitcoin directly, whether it's through the ETF, and whether it's investments into the liquid products, that's really going to accelerate once you start seeing the first couple big players make those moves more significantly. So I think it's really just getting a couple of those big players more involved, more interested in getting them to pull the trigger. And we think the possibility of those players entering in the next 6 months, one of the big players kind of taking the lead over the next 6 months is quite probable.
Martha?
Yeah, I'd just like to add on the point of when are we going to see more institutional adoption? Well, for us, it's a process of education. In addition to having standardized products, ease of access, and regulation, so we do a lot of education to traditional investors, and we publish a survey every year, and we've been doing it the last several years, so we can see the trend, and the trend is really encouraging. So, like the number of people or institutional investors who think that digital assets are here to stay has doubled over the last 3 years or so, and people or investors who have some exposure as well is steadily growing. And keep in mind that the last survey that we did was in 2023, so that's a point where this market was still a bit muted. We were still had the overhang from the 2022 correction, and even then we saw like this progression. And it's also there's a regional breakdown. So Asian investors are much more exposed to digital assets than other regions, and there's a generational divide, which I find fascinating. So it's kind of slow work in progress. In this survey, keep in mind that we survey thousands of institutional investors from smaller hedge funds to family offices to endowment funds to large pension funds, sovereign wealth funds. So it's pretty wide ranging.
Very interesting. Paul, you at Pantera, you started one of the first Bitcoin funds in the world, if I'm not mistaken, in 2013. How did you tell the story at that point in time?
Thankfully, I wasn't with Dan in 2013, but he tells a story that he was chasing every friend and family member he knew down the street and telling them to invest in Bitcoin. Bitcoin was $65 US when we opened the Pantera Bitcoin Fund. It's been a decent return since then. I know we got close at the recent highs to like 100,000%. I don't know if I'm missing a zero or something like that, but clearly it's a ridiculous return. But I did join Dan in 2017 after selling my macro fund, and he convinced me it would just be a lot more fun. And I was a sucker for it because I was kind of a gold bug before that, and I did a deep dive in monetary policies and saw the issues there. And so I looked at Bitcoin, and then I reached out. Most of our business is actually in venture, and both in two forms: venture equity, early stage venture equity, and private tokens comprise our two largest strategies. We also do liquid trading, active management, but it's really evolved. And the client base has evolved from high net worth individuals to more family offices. Endowments came in, in 2018, actually, and that was really, and the underlying common thread that links all these types of investors, as I mentioned before, is they all have permanent capital. So either an individual or an investment board that's controlled or influenced by members that are okay with taking a stab at innovation, took that stab. We're still not seeing fiduciaries that have to match liabilities. Those like insurance companies and pension funds join, and I don't think they will until it becomes very clear from a regulatory standpoint. But it's really changed a lot just since 2017.
Yeah, so you mentioned you were a gold bug. Now we have interest rates coming down, and we have, obviously, gold has a lot of history, and usually when interest rates come down, gold performs very well. And we have seen that in the past few days, and we've obviously seen that all this year, even though interest rates have been relatively high. Bitcoin is often called the digital gold, but in reality, we seem to be kind of between being gold and being some kind of a risky asset. So in your view here, dear panelists, like where is Bitcoin, and how do we want to be the risky asset, or do we want to be the gold? Like, how do we get there, Martha?
Yeah, so one of the main obstacle that we get in our surveys for institutional investors not to invest in digital assets is volatility. So regulation and security concerns, but the top by far is volatility. So yes, Bitcoin specifically is a volatile asset. It's more volatile than any other asset class. So it's educating clients around that, and the volatility is skewed to the upside, and that a long-term horizon is needed to be able to kind of hang in there and not give up in times when Bitcoin is selling off over 50%. So that's part of it. Having said that, the volatility has been trending down over time. So as it becomes more mainstream, there's less volatility. It's a multi-year process because, of course, with less volatility, you could say maybe less upside, right? So
you can't make outsized returns without volatility, right? So
yes.
So you're not going to get the best of both worlds.
When the market does sell off, as we've seen in the recent past, investors do tend to sell what sort of has been more profitable for them. They kind of tend to reduce risk, and all correlations go to one. But then after that, Bitcoin has shown that it bounces back relatively quickly.
Dina, you run a long biased fund, so you embrace volatility, right?
We sure do, and volatility is really a gift. I think investors take that for granted. Hedge funds spend a lot of money on leverage in order to up the volatility of things like equities and bonds, and in Bitcoin you get it for free. If you go further out the risk curve, you can get even more volatility. So I think really just changing the mindset of thinking of the asset class in risk terms and just size down your exposure to a volatility you're comfortable with will go a long way. And so I think part of it is educating them on the beauty of the volatility that lets you put on the same bet in much smaller capacity, but still allows you to capture significant upside. So my perspective is the volatility is really an amazing opportunity for allocators, and they should take it as a gift, not be fearful of it. But
Maurice, how do you see this?
Yeah, I totally agree with Dina, because what you see is if there's a low volatility, they up the leverage. And what happened in Japan, beginning of August, you could see what leverage leads to. And are they actually selling? It's the one product that isn't leveraged, but tradable 24/7. So I think it's actually a good thing that we have volatility, because we can definitely profit from it. But also because, you can sit the ride out if you like. I mean, if it comes against you, as we've seen in 2022, if you just hold, or hodled, as we say it, then you're still fine. So I don't think it's actually too bad. But I agree with Martha, it needs time to grow, and as the asset class will grow further, the volatility will become less.
Michael, you're quant focused in your work, so how do you view those things?
Yeah, look, it's it's a very nascent market still. So there, I guess most of my fellow panelists are looking longer term. We look, intraday arbitrage opportunities. So the ability to be able to find, a market-neutral pair trade where you're long one asset, short the other, you have something called delta neutral, gives us the ability to capture that volatility in very small bite-sized pieces. And cumulatively, over the span of the year, you're able to build a very interesting return profile. So we're not hunting for a unicorn. We're looking to pick up pennies and not get run over, basically. But if you look at traditional assets, a lot of these arbitrage opportunities have been, they're not there anymore. There's so much money, there's so much different funds involved. Whereas in digital assets, there's less competition, there's more regulatory arbitrage. And so we're really excited about the next 3 to 5 years and how we can build out more capacity.
So I view Bitcoin as a safe haven asset. It might sound silly, and I think a lot of people that haven't really researched it doesn't agree, especially people from traditional finance. But I view Bitcoin as a safe haven asset. It's volatile in the short term, but it has outperformed basically everything else in the long term. We saw last year in March when banks were failing and Bitcoin was rising. That was one of the pivotal moments, in my view, for when Bitcoin can show the world what it can do. It would be interesting to hear your thoughts on this. Like, where is the path towards Bitcoin proving itself as a safe haven asset? Paul.
So if we start with Bitcoin as digital gold, and we think about that, and the amount of above ground gold mined for all time at current prices is worth about 17 trillion or something like that, half of which is in the form of jewelry. And in places like India, that is a store of wealth in their view. But most liquid markets, that it's not treated that way. A quarter of it is in the form of, or being held on central bank balance sheets, which leaves about a quarter of the 17 trillion as a store of value, specifically an actively managed store of value in investor portfolios, or more to the point, savers portfolios. So Bitcoin trading at $1 trillion, whatever it may be today, trillion three, market cap, as just a store of value. Does it have a lot of upside? Has definite upside. I think the greater potential within Bitcoin per se is in the stack, if it can turn into a payments mechanism, a payment blockchain. And that's the exciting part about Bitcoin. Obviously, that would compete with a lot of other platforms and stacks that we're seeing, we see a lot of opportunity, more so now in layer 2 scaling solutions and Web3 build-outs and toolkits and various other things. But we think the next, to use an analog, the next Amazon, buying Amazon early or something like that, is really away from Bitcoin. It's an opportunity, in our view, to speculate, good diversified research speculations in what will build out and what will truly be different about, not from a store of value perspective, but payments. We see many, probably in the future, certainly younger generations are going to feel much warmer towards tokens than they will shares of equity. Better governance, cleaner, more efficient. So we see it as a capitalization tool, and businesses in the future will use tokens for that. And founders are incentivized to do that because they don't have to manage anything. they can just get fabulously wealthy by creating the platform and then stepping aside and letting the market take over and distributing capital in a much more, merit-based way.
Dina?
Yeah, so I would add Bitcoin is the only currency that's always, or sorry, not Bitcoin, gold is the only currency that's been up only over, hundreds and hundreds of years, and Bitcoin also has a fixed supply. And so in the same way that when the gold became an ETF and kind of became financial instruments that people could use to bet against inflation, Bitcoin proposes a similar structured bet. And so as, institutions look to add Bitcoin into their diversified portfolios, you get registered investment advisors adding Bitcoin into the model portfolio. That just creates the same kind of opportunity on the upside. So I think it's more of an option on the store hold of wealth. And the pathway kind of from here to the future creates a lot of upside for Bitcoin. So it's much more of an anti-inflation asset that still is really, really underallocated. And so I think of it more in that way. It's not really storing value as it is something that has a very fixed supply, and the demand is still very, very early.
Yeah, and it makes sense that investors can be confused and maybe not perceive Bitcoin as a safe haven asset when it keeps getting sold off during the weekends when, there's a military strike in Israel or whatever. But the thing is, there's the only market that is open, so you can't really sell anything else. So that maybe that kind of confuses things.
Yeah, I think hedge funds, traditional hedge funds have started using Bitcoin to hedge their risk exposures over the weekend for this reason. And so you're seeing them using it as a risk transfer tool through when market hours are closed. And that's a pretty interesting dynamic. And I think the problem there is that, traditional markets are closed on the weekends. And for Bitcoin and crypto and traditional markets to really converge, you have a lot of tech debt that you still need to reconcile within traditional institutions. Like, is Goldman really going to go and enable weekend trading on their, across their whole stack and rip apart all their infrastructure? Probably not anytime soon.
Yeah, I saw this interesting stat that the crypto market has been open, obviously, since 2009, and that equates to the stock market being open since 1971, as we are always open, and we are open, 5 times more hours each year than the regular market, because we have the weekends, we have the nights, and we have everything. So this is a stark difference.
Yeah, maybe I can just add to support that. So previous to joining Algoquant, I ran crypto at one of the largest hedge funds in the world. And our issue there, I'll just pick one of 1,000. If you look at the blockchain and trading Bitcoin, the number of digits that you have to be able to put into the system is 3x what you do in traditional finance. So having to go into a system and create it so that you could actually have 18 decimal places versus 8 or 6 takes a year. And you've got 1,000 of these little problems for the institutional players to actually get involved. And so what's happening now is that we have a moat and a time where the crypto native players can actually flourish as the traditional finance firms start to retrofit their systems and get involved.
And that's the beauty of the ETF, right? That puts crypto into the traditional finance framework and not the other way around, and so allows investors to take advantage of the opportunity. So that's, I guess, step one of the big inflow of capital that we might see.
Exactly. Martha, you packaged up Bitcoin into a nice ETF in Fidelity. Were you guys over there? So that made a lot of difference for adoption, it seems. How do you see this going forward? Do we see other crypto assets than Bitcoin and Ethereum in ETFs anytime soon?
Well, that's going to be up to the regulators, really. But yes, we were actually noting that ETP product is Fidelity Asset Management, and I'm part of the digital asset side. We do custody and trading. Nevertheless, we're custodying the Bitcoin for those ETPs. We have our own custody stack. And we were actually pleasantly surprised by the speed of the inflows. We really were positive. We knew there was demand, but it was just the extent of it was really, and to quote someone else, this is not my statistic, but the QQQ took like over 600 days to get to the AUM that these CTPs have gotten so far in a very short period of time. So that's really blown away all our expectations. However, we do think that a lot of it has been retail money and the cash and carry trade, certainly. The stickier money, the more institutional money, that takes time, and that's been very well discussed. But we certainly wouldn't be investing in the space if we didn't think that was the case. I mean, speaking to my colleagues who joined our department 3 years ago, there were 150 people on the team. Now we're almost 800. So that already is signaling to you the potential that we're seeing in the market.
That's a very good sign. Maurice?
Yeah, already BlackRock this week launched the options on the ETFs. So that makes it also possible for the institutions to hedge their positions more easily. So I think that also brings something to the table. But I just want to get back to one thing Paul said. If we would add another $1.3 trillion to Bitcoin at this moment, that will do a little bit more than double the price. So I think you will see 10x then at least. So because there's not a lot of free flow out there, and I think with the institutions coming, this is going to emerge a lot faster and quicker and larger than we think.
I agree with you on that one.
And the implications for ETH are even greater because ETH is obviously a lot less liquid than Bitcoin. And so even if a small share goes to ETH, that's, many, many multiples above. So I think we have a really good setup here and a good foundation.
I just want to say one other thing around the adoption. One thing that could accelerate adoption is any sort of instability in the markets. And we do see it as a hedge in that sense. Although we are positive on the macro outlook over the next few months, the structural deficits in especially developed countries around the world is really a concern to us over the longer term. And to us, Bitcoin is a hedge against that possibility.
You talk about structural deficits. I think that applies to the U.S. as well. So if we look into now the elections are coming up, and U.S. has been, I think they're running 7 to 8% deficit right now. The debt burden is over 35 trillion, up from 10 trillion in 2008. Very unsustainable. It doesn't seem to matter if it's Republicans or Democrats. The trajectory has been all the same, and as Lynn Alden, the famous economist, says, nothing stops this train. Does it matter for the fiscal situation, if it's Trump or if it's Kamala that wins? I think we most all agree that Trump is a more pro-crypto, but do you have some color on that? Maybe Paul?
I think the Harris administration very recently is beginning to understand that another train has left the station, and that's you can't kill Bitcoin, you can't kill crypto. It's a global market, and the U.S. is losing innovators. 3 years ago, 65% of our founders that we sponsored lived within 3 miles of our San Francisco office. Not because everyone in San Francisco is brilliant, but because it was a community that attracted wonderful developers. It's reversed since Gary Gensler has been at the SEC. It's been hostile. I think the Harris administration now gets that that's not what they want. They want the U.S. to try to lead. And it goes beyond just thoughts of scammers and Bitcoin and people doing like that. It's bigger than that, and they're beginning to see. I almost trust if that administration begins to be supportive of cryptocurrencies, it might be less fluid for us in this community than if a Trump administration comes in. He's promised to have Bitcoin reserves. That would be great, and we'd love it. Bitcoin would soar in the near term. But what we really want is credibility. What we really want, I think, as a community, is good, logical approaches to the space.
Michael?
Yeah, I guess I lived in New York. I left in April, moved to Dubai. I was in Singapore for Token last week. I'm here, and we're investing in Europe. So it's a wait and see in the U.S. This is a global, initiative, and I think it's really like an exciting time for Europe and the rest of the world to actually, surge into this. The U.S. has given the rest of the world the opportunity to really go for it, and so it's that's why I'm excited to be here and talking to you folks, because it's an exciting time to, whether it be Lisbon, Frankfurt, Switzerland, Iceland. It's a fun time to be.
For sure. Anyone with some color on the elections in the U.S., Maurice?
Yeah, I think it doesn't really matter who wins the election. It's just a matter of time. Maybe with Trump it goes a bit quicker, but on the other hand, he's probably gonna lower the interest rates more faster if it's up to him. He thinks he's in charge. But it also will be trade wars and tariffs, etc., which for the general economy isn't good. So it depends a bit on both, but in the end, I think digital assets will surface anyway, no matter who wins the election. As Paul said, you cannot stop the trend. It's just a matter of how quick it will happen.
I agree with you on that one. We're almost out of time. I'm going to put you on the spot, and we did not discuss this beforehand. So I want you to tell me what you think about interest rates, how much they will go down in the US until year end, and where is Bitcoin trading at year end. I'll start to make it easier for you. So I say 75 basis points lower than we are today, and Bitcoin will be at 95,000. Michael?
I was going to say 50 and 100, but somewhere in the middle of you.
50 and 85.
50 and 95.
Someone much smarter than me said, if you're going to make a prediction, don't put a time frame on it. And so by the end of the year, I have absolutely no idea. But I think in this cycle, if you'll allow me, Bitcoin probably goes up significantly higher than 130, and then settles, comes back down to 130, and I get that just by extrapolating past trends, past cycles, and no idea what the Fed's going to do, except drop rates over the next 2 years.
Martha, do you have a prediction?
I wouldn't like to speculate. However, we have done some work around modeling, network effects and adoption curves and extrapolating from the adoption of the internet and mobile technology over, a very long period of time, over 10 years, 10, 15 years. And you do get a very wide range depending on the rate of adoption. So, I don't want to give up specific numbers, but multiple times where we are today over the very long term. And in terms of interest rates, I would say I would just go with what the forward curve is forecasting, because a lot of people who are much smarter than myself are already kind of doing the work around that.
Thank you. Well, this is the end of the panel. I want to thank you all for a great discussion, and I want to thank the audience for staying with us the whole time. It's time for lunch.
Thank you so much, Michael, Dina, Maurice, Paul, Martha, and our wonderful moderator, Dadi, joining us all the way from Iceland. It is indeed lunch, so we say bon profit, buen provecho.